Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
And good morning. Welcome in for another edition of Retire Right with Rick Durkee at its new time, 9 o'clock. I'm your host, Shane Griffin. Each and every Saturday morning here at 9, I have the privilege of sitting down with our local retirement, income planning, and wealth distribution specialist, Rick Durkee, to help you to retire right. Good morning, sir. Good to see you.
Good morning, Shane. Glad to be back here in studio with you.
Yep, absolutely. Going to be an interesting discussion this morning. We're going to talk about Warren Buffett.
Warren Buffett. He's got some good Buffettisms.
Absolutely. They call him the Wizard of Omaha or the Oracle of Omaha.
Yeah.
So we've got an interesting article about Warren Buffett coming up here this morning. But before we do that, a couple of things to keep in mind. We like to do this before we start each show. Number one, if you have a question, a concern, or would like to set up an exclusive three-step review with Rick and his team, the phone number to call is 843-735-5065.
And Shane, before you go on to number two.
Okay.
If you call in now while that question is hot and you don't forget it, okay?
Right.
Call in as soon as that question comes in. You're probably going to leave a message because the phone lines will take your voicemail and we will return your call as soon as the show is over.
Okay, 843-735-5065, the number to call. If you'd like to visit the website, you can check the calendar of events. There are a number of tools and things to look at there on the site. You can also send Rick an email through the website. That site is cfpgroup.biz, cfpgroup.biz. And thirdly, if you'd like to listen to past programs, maybe you heard a show, want to hear it again, maybe you tuned out halfway through, or maybe just missed it altogether, all of the shows are podcast on two sites, Rick's, cfpgroup.biz, and also 943wsc.com. Just find the podcast page. All the shows are there with the titles. You can easily find them. Free, on demand. There you go.
Hey, and we're going to have some resource today that you're going to want to call in and request a copy of or email us at rick@cfpgroup.biz to obtain that resource.
So the topic this morning, Warren Buffett has a year to forget. It was a tough year for most investors, Rick, including the most legendary one out there, Warren Buffett. His Berkshire Hathaway had its worst year since 2008. Shares of Berkshire's A and B shares were each down about 13% in 2015. The last time the Oracle of Omaha's company did so poorly was in 2008 when both classes of Berkshire stock fell 32%. In 2015, Buffett lagged the market. The S&P was down about 0.7%, and he lagged the market. Even the top investors that people admire, Rick, like Warren Buffett, don't always beat the market. They do lose as well, correct?
Well, Shane, quoted this one before. I'll use it again here so that people can understand that even the big ones fall sometimes. Warren Buffett's number one rule in investing: never lose money.
Right.
All right. His number two rule?
Yeah.
Never forget rule number one.
C number one, right.
Yeah, C number one. So, yes, people, we have to understand that as markets do what they do, that they are guaranteed to go up and down.
Yeah.
Okay? How much you allow them to go down is the key to investing.
That's right.
And, just a real quick point here is, Shane, when Warren Buffett saw that he was losing terribly in a few of his holdings in 2015, do you realize what he did?
No.
He went out and bought more of them. He did. He bought more shares of those two holdings. So it just shows you if you've got a plan and you stick with
That's right.
you have a
and
process.
That's his plan. Yeah.
You have a process, and it's for the long term that you can't lose. And so, well, down a little bit on a calendar year measurement, folks, I think we need to get away from this year and month and quarter, review of how things are doing. Quit micromanaging. If you have a plan in place and you know that it's going to accomplish your goals, then you should be looking out at a time horizon, especially with investing, of 5, 10, or maybe 15 years if we're in a volatile time like we are right now, to allow those averages of the goods and the bads and the uglies to all average out. But here's my key. let's make sure we take that last one out of the picture. Let's get the uglies out of there, all right? Let's make sure that we're making proper financial decisions and we're going risk off when we need to and not riding it all the way down and buy and hold strategies that may have worked in the past but failed miserably in those years of 2007 to 2009 when we had a 51% drawdown in the S&P 500 index.
Well, let's dig more into the numbers. The last time that Berkshire had a down year and underperformed the S&P was all the way back in 1999. That year, the S&P gained 19.5%, while Berkshire's A shares fell 20%, and the B shares were down 22%. Even though the overall market was down in 2015, there are some similarities, Rick, to 1999 to help explain why Berkshire has been a worse investment than the S&P. What do you see, sir?
Well, Shane, in 1999, large tech stocks soared.
Yeah, well, yeah.
Right? And this year, they're a big reason why the index hasn't suffered a worse drop. Netflix and Amazon each have more than doubled.
Yeah.
Alphabet is up more than 40%, while Facebook has gained more than 30%. And just as Buffett lacked exposure to the Microsofts, Cisco's, Qualcomm's, Sun Micros of the world in 1999, he has no investments in this year's Fab 4 of tech. So that has hurt Berkshire. But making matters worse is the fact that so many of Berkshire's largest holdings have tanked.
Yeah.
And so combo those two things up, and so he doesn't have a real good year. Again, he's in it for the long haul. He has a process. He does understand the fact that markets will go up and will go down, and sometimes timing just doesn't work out right. But it is not timing the markets. It is time in the markets. Time in.
Well, let's speak for a moment because let's say someone is listening at home this morning and saying, this is great information, it's interesting to know about Warren Buffett, but what does it mean to me? What do I care how well or how bad Warren Buffett does? I think there's really a lesson in that, though, right? I mean, we touched on it a little bit in question one, but I think I'd like to dive more into that.
The point here is that Buffett has a process. It is long-term, and that's what he's in investments to do, is to get average rates of return over long time periods of time. And he understands that things will go up and down, as I mentioned just a moment ago. Our client or our prospective client that comes into the office also has a long-term plan, all right? We're talking about retirement here, folks. We're talking about from age 60 or older, or maybe if you had a nice business that you sold and you're younger than that, then kudos to you. But typically that average retiree is 60, 65, somewhere in that range, and they have 20 to 30 years to still plan for in retirement. That is a long time horizon, folks. And so we have to address those concerns. We have to make sure that you're properly allocated amongst different asset classes. We have to make sure that you have fair expectations for what you'll earn. We have to make sure that you are willing to take a certain amount of loss in order to get gain. Because as I said many times before, risk and reward are traveling companions. The more risk you're willing to take, or the more potential loss you're willing to stomach, the more potential gain that you will average out over time. You have to put that all in perspective, that it's a long-term plan that's going to last 20 to 30 years in retirement. And if your number one objective is that you make sure you preserve your principal so that it's there for future needs in case that financial roadblock comes along in retirement, that you're protected, then you're going to have to live off of that interest and make sure that you're withdrawing the earnings out of those investments and not dipping into principal. And you're going to be subject to a lot of risks during those times, but one of them, which is a risk multiplier, is going to be longevity. So I'm trying to get back to the point here, Shane, of why our listener wants to pay attention today to what Warren Buffett will share with us and what Berkshire Hathaway does is it's a long-term plan. And what he does is if things don't work out as planned, he knows what simple adjustments that he can make in his investments so that he will still accomplish his goal in the long term. I want to share with you a story of a client that we had, that we still have actually, that was a business owner. He's no longer a business owner. He is retired now. But what he did was, when we knew him during his working years, he took a lot of risk in business. And every year that he had a loss, an investment that went south, okay, be it a business that he invested in or whatever, if it was a big enough loss, what he would do is he went out and he took out a life insurance plan for the amount of that loss.
Wow.
Now, why would he do that? Because his long-term plan is for his estate to pass on at a certain amount. And he was steadfast in that belief that he would pass on at least what his principal was today, and maybe what it might grow to, factoring inflation and all that, minus any losses. And so,
interesting concept. I've never heard of that before.
The easiest way for him to guarantee that his estate would still be worth that amount was to take that loss and say, okay, life insurance will pay for it. And so he would just fund life insurance out of future revenues from his businesses or from his investments in the future, and it would guarantee that he would still his plan would come to fruition. So there's a lot of different ways to look at things here, folks. Really. But my point here is this particular person had a plan. He was excuse my French, hell or high water, he was going to accomplish that plan, but he was going to stick to that plan. And so this is just another example when we look at Warren Buffett, where he, has two major losses in two stocks. He goes out and buys some more, even though they might even drop some more. But he buys at lower price.
Absolutely. You're listening to Retire Right with Rick Durkee. The topic this morning, Warren Buffett has a year to forget. If you'd like more information on this article, Rick is happy to email it to you. Send him an email, rick@cfpgroup.biz, rick@cfpgroup.biz. If you'd like to go ahead and schedule an exclusive 3-step review this morning, 843-735-5065, the number to call. Check the website for a calendar of events, cfpgroup.biz, and listen to past programs at 943wsc.com. Search the podcast page. Look for Retire Right with Rick Durkee. All the programs are there with their titles, so you can listen to those free and on demand. Back to the program, Rick. I wanted to spend some more time with that long-term horizon view that Mr. Buffett has, because it's unlikely that he'll change his investing habits because of one down year. This is probably something someone listening at home this morning has considered and said, well, that didn't work. Let's try something else. It's very important, I think, to, number one, make a plan, or as you like to call it, a process, put a process in place. And number two, stick with that plan and or process and see it through to the end.
It is, Shane. Let's just look at some numbers here. Berkshire's B shares, as you mentioned earlier, are up 123% over the past decade, more than double the S&P 500's gains of 58%. And the cheaper B shares, aka the baby Berkshires, began trading in May of 1996. They're up 541%. compared to 201.5 for the S&P 500. So if history is any guide, Buffett will bounce back next year. And this is a perfect example of what we've touted year in and year out here on Retire Right, is that opportunity arises after bad things happen. And, Buffett, he'll bounce back again next year. Berkshire's B shares have never suffered 2 consecutive years of declines.
Really?
But, hey, we got to say this too, because things are happening differently. If he does, it just means that rubber band may snap back even better if he has 2 consecutive years of declines. The last time that his A shares fell 2 years in a row was way back in 73 and 74.
Holy cow, that's when I was born. 42 years ago. Incredible. 43 years ago.
Gosh, you're old.
Yes.
All right.
Not as old as Rick Durkee, though.
Well, I'm just closer to retirement, Shane.
So again, the key, though, is to come up with a plan, stick with that plan, and I think that's what makes you and your team at the Coastal Financial Planning Group different, is that you develop that plan, develop that process, and then you see it through to the end, recognizing there will be ups and downs. But if you can manage the downs, that's really the big part of that. Manage those drawdowns as best you can.
Shane, last year I had a guest on the show, Tony Epolero. He is one of our investment committee members for the Coastal Financial Planning Group and many others across the country under the Precision Capital Management platform that we are investment advisor representatives for. Tony studied under Warren Buffett's current number 3 man.
Right.
And so he picked up a lot of information from this mentor. And Tony manages our stock portfolio for us and manages our domestic equity portfolio. And Tony has he's full of Buffettisms. I'm sure we'll have him as a guest back on 2016 here on Retire Right, and he'll be able to share some of his wisdom regarding Warren Buffett and what he's learned over his years in the business. But the key here is that as we look at opportunities in 2016, there certainly will be some in some different sectors of the U.S. domestic stock market. Who knows how many or how they may perform. Hopefully there'll be enough performance to squeak out some positive performance on year end on our clients' overall portfolios, and maybe the year that was nothing will end up being a year of something in 2016, that there'll be some opportunities in different asset classes for our managers to provide some decent returns for our clients. But it's about this. You started out the question with, how Warren Buffett and Berkshire has been extremely well served by having a plan that's successful because it's investing in the long term. And retirement is long term. Yeah. We need to plan on 20 to 30 years, folks, of longevity in retirement. And we want to make sure that all concerns are addressed regarding making sure that money lasts throughout retirement, that's earmarked for income, making sure that we are protecting ourselves against risks or potential roadblocks that will come along in retirement. Inevitably, they will come, folks. Yeah. And then thirdly, that we make sure that we keep Uncle Sam out of the picture in all of our legacy planning and pass on what we want to who we want in the most efficient ways possible with our legacy planning.
Even Warren Buffett, Rick, has an off year, so it's likely that someone listening this morning did too. To ensure a retirement income plan that's opportunistic in good times and defensive in bad times, something that you talk a lot about, what are some things that people should be doing right now?
Well, first thing I would do would be call us, 843-735-5065, to request a white paper that we created this year, which was a recap of last year. It has a lot of information in it on Berkshire Hathaway and as a comparison and what they did in 2015. And I'm sure you could learn from that information. That information comes from our investment committee at Precision Capital Management and Tony Epolero, who I referenced earlier. Yeah. So request that white paper. We'll email that out to you. Call us at 735-5065. The second thing is, Shane, is that we need to develop a plan if you don't have a plan. If you have been in your accumulation years and you're up to this point in life where you say, I'm really in that so-called retirement red zone. I am very close to retirement. It's time for me to develop a plan. And it's time for me to have somebody that's going to coach me through this 20 to 30-year period called retirement. Then certainly take advantage of our 3-step review offer to all listeners of Retire Right. Now, the 3-step review is a simple process. It is a process of discovery. However, the problem is that you can't take yourself through this process yourself because you've done a very good job at following processes to get you to where you are today. Yeah. Through your accumulation years, you've done whatever it took to accumulate to get to the point of where you feel you can consider retirement. But now you don't know what questions to ask to get the information that you need to properly take you through this period of time in life called retirement and go into your decumulation years, where you're going to have to spend down these assets. Right. You're going to still be hopefully accumulating wealth and growing your assets, but you're also going to need to start taking income from those assets. Yep. A 3-step review will always give you the questions that you need the answers to help you make proper financial decisions in the area of how do I properly take this asset and convert it to income from a tax standpoint, from a income and distribution standpoint as to what my plan is, as to how I want to use this money, when I want to use this money, and what's left over does what I want it to do for me.
Right.
Okay. And then thirdly, we evaluate all financial decisions as we go into retirement from a risk standpoint. Now, Shane, the risk standpoint is where we see the most adjustments made.
I bet.
All right, because typically we've been in our accumulation years. The market has been going up. If we look at the U.S. domestic stock market, it's been doing well over the last 5.5, 6 years. But now we're moving into retirement, and we can't afford sequence of returns risk as we take this money and spend it down. And so we have to readjust our investment risk. We have to look at what other risks are involved in retirement. Longevity risk, how long we're going to live. We have to look at other risks, health care, all right, make sure they're protected. We need to look at other risks, such as tax risk in the future. Inflation. We have to mitigate those risks. And so a complete 3-step review will take you through a process of discovery that shows you the information that you need to know by asking a series of questions that we do hold those questions proprietary to us as the Coastal Financial Planning Group, because we've been doing this for 10.5 years now, where we know what questions need to be answered, but we don't want to come across as the know-it-alls. We want to help our potential retirees discover through a process of educational discovery what information they need to know so that they can make these decisions, and that they know that those decisions in the end will be in their best interest because they've learned them through this process of discovery, and they put together a plan, and then now they feel confident that that plan will take them through the remainder of their life in retirement.
And if I could add to that, you're a fiduciary, so you're required by law to help clients and prospects make decisions that are in their best interest and not yours. That's really the difference between you and what a quote-unquote broker does, correct?
That is, Shane. And we will see in 2016 more and more of the government being involved in that fiduciary responsibility of investment advisors to give fiduciary recommendations and also help people make these decisions. And so, folks, we always did this to start with. It was, it's why we do what we do. We want to make sure that we are creating a life of significance for ourselves and our clients. And the only way that you can do that is by giving advice that helps others.
Right.
It's not meant to. It's not meant to hurt anyone, and not to say that past advice was meant to hurt anyone, but I just don't think that the underlying principles in why that advice was given was in the client's best interest, and it was done to help others. I think it was more leaning towards helping the company's bottom line, all right, the company. And now in 2016 and beyond, we see more and more companies set up to help other people. And those are the companies that will rise in the stock market in years to come. Companies that are they're tasked with the desire to leave a legacy, to know that they made the world better, and not be doing things just for profits. So profits come when you do the right thing.
Absolutely.
And that's what I think we'll see more from the fiduciary responsibility of investment advice in the future, and that's my hope and my goal, is that the industry does that as a whole.
Well, before we let you go here this morning, Rick, a couple of opportunities for our listener to gain some free information. You've got a white paper available, correct? And then also a book by David Gaylor.
Yep, we got an income allocation available today for the first 5 callers. We'll make that book free and available. We have upcoming workshops. Check the calendar of events. We have some great workshops planned in February. We have the Rejuvenate Your Retirement courses at College of Charleston. Those do include a fee to the College of Charleston. All fees are paid to the College of Charleston, $59 for that fee. It's a 2-day course. And then we have our complimentary dinner seminars at Ruth Chris coming up here in February, too. So a lot of opportunities for follow-up on what you learned today, folks. We always ask you to take advantage of the educational resources that we make available to you. Call us at 735-5065 if you'd like some more details, or the white paper that I referenced earlier. And hey, final point.
Yep.
Join us again next Saturday.
That's right.
Will you join us, Shane?
I'll try to be here.
Okay. I think you've done really well doing it for the last 8 years. So
I'll see you next week.
All right. Hey, I appreciate that. And I appreciate you, our listener, that's retirement-minded, joining us each and every week here at 9 a.m. on Saturday mornings on 94.3 WSC FM and 94.3 WSCFM.com.